FAR has 4 investment accounting frameworks: fair value, equity method, consolidation, and joint venture equity method. If you load the wrong one, you're going to waste 90 seconds and you're going to end up picking the wrong answer. Here's how to know which one you're on before you even read the question. You look for these keywords: non-controlling interest. You know it's going to be a consolidation greater than 50%. Acquisition date. That's a business combination under ASC 805. Intercompany. It's going to be inside a consolidated group. Eliminate it. That transaction never happened. It's fiction. It was made up by an exam writer. Or significant influence. That's the equity method between 20 and 50%. So look for these 4 keywords and you won't waste 90 seconds reading the whole question. You'll know right away which framework you're in, and you can probably guess what the question is even asking before you finish reading it. That's going to save you a lot of time, and you're going to be a lot more accurate. So I'm going to load up a few questions from ChatCPA's test bank on FAR equity, FAR investment questions. So this first one, Pella Co. purchased 30%. Okay. Don't care about the amount. Significant influence. So that's one of the buzzwords. So significant influence means it's equity method between 20 and 50%, but you can also see right away they purchased 30%. So there's 2 flags for you to know that this one is equity method. So you're going to take your pro rata share of net income, of dividends paid, amortization of whatever they might be amortizing, your 30% in this case, 30% of the net income, 30% of the dividends paid, and you're going to calculate what the actual reported investment is. Most likely, that's probably what the question's asking because I see a lot of numbers here. But let's see what is the most supportable amount Pella should report for its investment in Sona at the end of the year. Okay, so this one we're going to have to actually do some calculations on. And I'll pull up the spreadsheet because that's what I like working in most. So what was the purchase price? 1140. What else is in here? 3 million. I don't care about that. The fair value exceeded. Don't care about that. No. 300,000 for equipment. Okay, over 10 years. So we back that out pro rata. So it was 300 for 10 years. So it's 30 a year times their share. So, but it's a negative. Okay. What else? 150,000 for customer-related intangible, 5-year life. Okay, so same concept, but it's for 5 years, and it's pro rata at 0.3. Any remaining excess purchase, goodwill. Okay, assume Pella owned the investment from the date. Okay, fine. Through the year, fine. It's just basically a full year. And the reported net income, 360,000. So you take their share of that, 360 times 0.3. You add that in. Anything else here? 120,000 dividend. Okay, back that out. 120 pro rata. Assume no impairments, no fair value options, nothing else. Okay, so it's just the combination or the sum of all those things. 1194. Is that an answer option? Yeah, it is. Okay. I'm pretty sure that's the answer. Yes. Okay. But it's important. Read why the other ones were wrong. A, tempting because it results in total dividends instead of 30%. So you didn't take the pro rata on dividends, and that's how you ended up getting A. C, probably the same thing. Amortizing 9,000, omitting intangibles of 9,000. Okay. Yeah, so you just didn't correctly apply their pro rata on the items that need to be adjusted based on their percentage that they bought. That's the equity method. Next question. Get rid of that. Okay, scan for it. Business combination. Okay. Acquisition date. That's one of the buzzwords, right? That was a business combination under ASC 805. So that means assets and liabilities are mark to market, fair value. You plug goodwill. You look for separable intangible assets because those come out of goodwill. But things like assembled workforce, they stay in goodwill. So let's actually see what the question's asking for. All fair value are reliably measurable. Under U.S. GAAP, which of the following should entity A recognize as intangible assets separate from goodwill at the acquisition date? Okay, so we're going to look for things that can be properly accounted for separate from goodwill. Registered, let's just read each one of those. 1, 2, 3, 4, 5 of them. Okay, so registered trademark with a legal protection and an expected economic life of 10 years. Okay, so that one can be separated. Customer subscription contracts. Okay, so an actual contract with enforceable terms, those can also be separated from goodwill. An assembled workforce, that one stays in. Ding, ding, ding. Here you go. Number 3 here. Not separately transferable. You're going to see that a lot on these questions. This one's a very common one that you cannot separate. Number 4, an incomplete in-process research and development project. That one can be separated. 3-year non-compete agreement with former owners. That one can also be separated, no problem. So let's look at the options. We're looking for the one that doesn't have that assembled workforce because it cannot be separately transferable. Assembled workforce, right there. Cross off A. It's in. B, registered trademark, assembled workforce. Cross off B right there. C, the customer subscription contracts and the 3-year non-compete agreement. So those can both be separated. So C is not a cross off. That could still be the option. The registered trademark, the customer subscription contract, the in-process R&D. Okay, so that one also can be separated from goodwill and marked as an intangible asset. So C is a good answer. D is more complete. That's your answer. Yes. Read why the wrong answers were wrong. The only other one we were going to pick was possibly C. So this choice correctly identifies contractual assets, but wrongly omits the other ones. Yeah, the in-process R&D and the registered trademark. So D was more complete. A and B were instant cross-offs because you saw they had that workforce in there. Number 3, Moss co-acquired the following investments in year 1. Assume all investments are publicly traded common stock. Okay, so we're looking at, let's see, which investments is the clearest exception to the general rule that equity securities are measured at fair value with changes recognized in net income. Okay, so fair value, there's your buzzword. That's mark to market, right? The fair value through net income, FVTNI. So right away we know this is the 0 to 20% fair value. Just scanning these, all of these are less than 20% except B. So I'm going to read the question a little more, but I'm going to highlight B because I'm thinking that one would be the answer. Let's exercise significant influence. So yeah, let's pull in that buzzword, the keywords to look for. Significant influence, that's equity method, that's 20 to 50%. So that one's not going to be included when you're measuring at fair value, right? The question asks which investments is the exception to the securities measured at fair value. So because they exercise significant influence and that this is greater than 20%, that it's going to be the equity method and is not fair value. So the answer is definitely B. and read why the others were wrong, of course, but all the others were below 20%. And this is B is the one that said significant influence. So B was the easy option to get through, even if you only knew the keywords to look for and the 4 frameworks that you're working with. You could find the answer probably within 30 seconds of just glancing, looking for keywords. There are other keywords. It's like some bonus keywords, fair value through net income. We talked about that. Joint control, controlling financial interest, variable interest entity. Those deserve their own video, and I'll make a video for those later. So subscribe if you want to watch it as soon as it comes out. But otherwise, there's 2 main takeaways from these questions. They're not hard, the FAR investment questions, if you know the frameworks and you know the keywords to look for, which you do because you watched this video. But they become hard if you're operating under the wrong framework. If you accidentally apply the fair value framework to a consolidation or vice versa. So the question will tell you generally with the buzzwords whether it's a consolidation or a joint venture or equity method or acquisition, non-controlling interest. Look for these buzzwords so you know which framework to use. You can predict the question and you'll be a lot more accurate. So if you want to drill this, go to the free trial at chatcpa.io/exam and try a couple of these framework questions and see how you do.